If you are an investor who wants to use the margin of safety when investing in the stock market, then this video is for you. In this video, I'll be sharing with you how to use the margin of safety in the stock market so that you can minimize your risk and increase your probability of success in the stock market. And if you stay till the end of the video, I'll be showing you a real life example of how to use the margin of safety in the stock market. Alright, so let's begin. Before we dive deep into the margin of safety when investing in the stock market, let me give you an example to better explain what the margin of safety is. Let's use this lemonade as an example. So to make a lemonade, we need a couple of things. The first thing that we'll need is sugar. So let's say the sugar costs $2. We'll need lemons, and the lemons will cost $3. And we'll need water, so water is free. And we'll need a jug to contain the liquid, right? So let's say the jug costs $5. So the total value or the total cost of all these different ingredients and items to make a lemonade would amount to $10, right? If we add up all the individual ingredients and items, it would add up to $10. Let's say we are making our way there to the supermarket and we met this guy, right? So this guy happens to also love lemonades. And he so happens to have the ingredients and items that we need to make a lemonade. But unfortunately, this guy is in a bad financial condition. So he needs to raise some money. He approaches us and asks us whether we would like to purchase these different ingredients and items from him. Instead of selling all of this at $10, he is selling it to us at $5. Would you want to buy the ingredients and items from him at $5? Chances are, if you like lemonade like I do, you will probably buy these ingredients and items from him. Why? Because we are getting a massive 50% discount by purchasing these items and ingredients from him instead of purchasing it at a supermarket. If we purchase it from him, we'll get all these ingredients and items at $5. But if we purchase it from the supermarket, we'll get it at $10. It makes more financial sense if we purchase these ingredients and items from him rather than from the supermarket. On our way back, we realized something. We realized that we miscalculated and overestimated the total cost of the items, specifically the cost of the jug. Instead of $5, the jug actually cost only $3. The actual total cost of the different ingredients and items is actually only $8. The question now is, did we make a good deal by purchasing the items and ingredients from that guy? Or would we have been better off if we purchased the ingredients and items from a supermarket? We are still better off purchasing the ingredients and items from the guy. Why is this so? Because we purchased the items and ingredients from the guy at $5 and now the total cost is $8. Even though we might have miscalculated and overestimated the total cost and the total value of the ingredients and items, we still stand to gain because we purchased these items and ingredients at $5, which is still less than $8. Because we had a large enough margin when we first purchased the ingredients and items from the guy versus purchasing it from the supermarket, we still managed to get a good deal because of the large enough margin of safety. And this is kind of similar to the margin of safety when used in investing in the stock market. Why have a margin of safety? The first main reason why we want to have a margin of safety is that it gives us more leeway. Because when we are projecting the value of a company, we need to take the future into account. And the future by its very nature is uncertain. So with all these uncertainties, these projections are at best just estimates. And that is why we want to have a margin of safety. Because with a margin of safety, it gives us more leeway in case our estimates are incorrect. The second reason why we want to have a margin of safety is that it gives us an increased probability of more profits in the stock market. I put an asterisk beside it. And the reason why I put the asterisk is because this is based on an assumption. And the assumption is that over time, the stock price will always move close to its intrinsic value. In the short run, emotions drive the stock price of a company. But in the long run, it is the fundamentals of a company that drives its stock price. The stronger the fundamentals of a company, the higher its intrinsic value and the higher its stock price over time. If we buy a stock which has a high margin of safety, which means that its current stock price is way below its intrinsic value, this theoretically means that it increases our probability of making greater profits when investing in this stock. What is the margin of safety when investing in the stock market? To put it in a sentence, it is basically investing in a company below its value or intrinsic value. And if we were to put it in a formula, this would be the formula for the margin of safety. The formula for the margin of safety is taking the intrinsic value of a stock minus its current stock price. Now that we know the formula to calculate the margin of safety, let's take a look at some examples and calculate the margin of safety for these examples. Okay, for the first example, let's say the current stock price is $95. and the intrinsic value of that company is $100. So what will the margin of safety be? The margin of safety will be taking the intrinsic value of a company minus its current stock price. We will take $100 minus $95. So the margin of safety is $5. Let's take a look at a second example. The current stock price for the stock is $80 and its intrinsic value is $100. What will the margin of safety be for the second stock? The margin of safety for the second stock would be the intrinsic value, which is $100, minus its current stock price, which is $80. So 100 minus 80 will give us $20. So the margin of safety for the second stock is $20. Assuming all other variables and things remain constant, which stock will you want to invest in? The first stock with a margin of safety of $5 or the second stock with a margin of safety of $20? As investors in the stock market, we want to invest in the second stock because it has a higher margin of safety, and this higher margin of safety gives us a greater safety net in the stock market. Alright, so that's how we calculate the margin of safety when investing in the stock market. The next question you might have is, now that we know how to calculate the margin of safety and we know how to determine the current stock price of a company, how do we calculate the intrinsic value of a company? There are many different ways to calculate the intrinsic value of a company. But this is beyond the scope of this video, because if I included all the different ways of calculating the intrinsic value of a company, then this video will run on forever, right? But if you'd like to learn the different ways to calculate the intrinsic value of a company, comment down below the topic that you want to learn and I'll definitely check that out. Okay, so these are just some couple of ways to calculate the intrinsic value of a company, and there are no right or wrong. So the first one is using the discounted cash flow method. The second is using the net current asset value. And the third one is to use the book value. Let's use the book value as an example to calculate the intrinsic value of a company. The book value formula is total assets minus intangible assets minus total liabilities. Let's take a look at how we can calculate the book value of a company. So the company that we'll be taking a look at is Tesla. To calculate the book value of Tesla, we need to take a look at the financial statements of Tesla, specifically Tesla balance sheet. The website that I use to view companies' financial statements is Reuters. Right now, I'm on Reuters homepage. So the first thing I want to do is to search for Tesla. So the ticker symbol for Tesla is TSLA. So I'll search for that. And then we have Tesla here. So I'll click on Tesla. And then I'll go under financials. So you can see that these are the financial statements of Tesla. We want to take a look at Tesla balance sheet to calculate its book value. So we click on balance sheet. Now that we are on Tesla balance sheet, the first thing that we want to take a look out for is its total assets. So we'll scroll down and then we'll have its total assets here, right? So its total assets amounts to 34,309. And note that this value is represented in terms of millions, right? So they say all values are displayed in millions and in terms of US dollar. So the total assets is 34,309. Then the next thing that we want to take a look out for is its intangible assets. So let's take a look at the intangible assets. So the intangible assets is 339, and it also includes goodwill, right? So goodwill is also part of intangible assets. So we add up the two to calculate the total intangible assets. So 339 plus 198, right? So that's the total intangible assets. And the last thing that we want to take a look out for is its total liabilities. So we'll scroll down to total liabilities. So total liabilities here is 27,691. Now that we have the values, we just need to plug it into the formula, right? So the total assets will be 34,309. So we double check. So we'll go here and then total assets is 34,309, right? So that corresponds to total assets. And the next thing that we want to take a look out for is the intangible assets, right? So intangible assets, like I mentioned earlier on, includes intangibles plus the goodwill. So we take 339 and 198. So down here, we include 339 and 198, right? So total assets minus 339 minus 198 minus total liabilities, right? So total liabilities, let's double check again. So total liabilities is 27,691, right? So this corresponds to the total liabilities here. So the book value for Tesla would be 6,081. And that is the total book value for Tesla. And again, this value is in terms of millions. But we don't want to just stop there. We want to find out the book value per share. So how do we calculate the book value per share? We take the total book value and divide by the total shares outstanding. We have already calculated the book value of Tesla. The book value is 6,081. The next thing that we need to find out is the total shares outstanding. And to do that, I use Finviz, right? So Finviz is another financial website. So the first thing that I want to do is key in the ticker symbol for Tesla. So the ticker symbol for Tesla is TSLA. So this will bring me to the page for Tesla, and I want to look out for the total shares outstanding. Down here, you can see that the total shares outstanding is 183 million. Right, so I plug in the formula. So I take the book value divided by the total shares outstanding. So it's 6,081 divided by 183. Remember, the book value is in terms of millions and the total shares outstanding is also in terms of millions. So we cancel that out and we arrive at a book value per share of $33.23. If you're an investor who places an emphasis on the margin of safety, does Tesla meet your requirement? To do that, we have to take a look at the stock price of Tesla. Current stock price for Tesla is $994. Is there a margin of safety when you choose to invest in Tesla right now? There's no margin of safety when you're investing in Tesla right now. Remember, the formula for margin of safety is taking the intrinsic value of a company minus its current stock price. We have determined the intrinsic value of Tesla using the book value formula, which is $33.23. And the current stock price, which is $994. You would have arrived at a negative value for the margin of safety. If you're an investor who uses the margin of safety as a criteria when investing in the stock market, then Tesla wouldn't meet your criteria. But that does not mean that Tesla is a bad company and that you cannot make money investing in Tesla. It just means that Tesla does not meet your requirement or your criteria when investing in the stock market. There are many different ways and strategies to make money in the stock market. But the important point is this. You have to find a strategy that, amongst other things, that you're comfortable with, that you understand, and also meets your risk profile. And the margin of safety is just one of these strategies that you can use when investing in the stock market. In a nutshell, this picture illustrates what the margin of safety is. In this picture, the red line is the intrinsic value of a company, and this curvy line is the stock price. The intrinsic value of a company is relatively stable over time. The red line represents the intrinsic value of a company, and you can see that the intrinsic value of a company rises steadily over time. But not all companies' intrinsic value will rise over time. Only those fundamentally strong companies will see their intrinsic value rise steadily over time. On the other hand, fundamentally weak companies will see their intrinsic value fall over time. And that is why we want to invest only in fundamentally strong companies, because the intrinsic value of these fundamentally strong companies will rise over time. And if we take a look at the stock price, we will notice that the stock price is a bit more volatile. So you can see that the stock price rises a lot here, and then it declines a lot here, and then it rises a lot here. So the reason why stock price is more volatile than the intrinsic value of a company is because in the short run, stock prices are driven by emotions. And that is why in the short run, stock prices tend to fluctuate and remain far away from its intrinsic value. But in the long run, the stock price tends to move back to its intrinsic value. As investors in the stock market, we ideally want to buy a company when its stock price is below its intrinsic value, right? So when the stock price is here and the intrinsic value is here, the reason why we want to buy a company when its stock price is below its intrinsic value is because it gives us a margin of safety. And as we have learned in the earlier part of the video, the larger the margin of safety, the greater the leeway we have when we are making our estimates of the intrinsic value of a company, and the higher the probability that we will make greater profits when we are investing in the company. And that is how to use the margin of safety when investing in the stock market. I hope you have learned something from this video, and if you did, smash that like button because it will help the channel grow. And if you want to watch more videos such as this on investing, trading, and the stock market, make sure you subscribe to my channel so that you don't miss out on any of these videos when I release them in the future. To your financial success.